here, cash flow question. So what they have done, this will be given to you in the exam. It will be given an Excel worksheet. Your work becomes really very easy. They've given us an example statement of cash flows. The following information relates to 𝐨𝐟𝐼𝐟𝐞𝐫. 𝐨𝐿𝐼𝐟𝐞𝐫, a limited liability company for the year ended 31st October 20X7. So they've given me extract of the income statement, finance cost. I can see investment income. I can see profit before tax. This is an item of interest. If I'm the one doing this exam, I'll come and highlight the entire row 8 and even bolden it, Control B. Yeah, that's a very important aspect for me. We have less taxation. We have profit for the year. And then they've given me the statement of financial position, statement of financial position. So we have assets and current assets. The first thing you're supposed to know whenever these examiners tell you to do a statement of cash flows, income statement will be the income statement for the current year. Only 1 year, only 1 year. But balance sheet, we must be given how many balance sheets? 2 of them. For opening balance and the closing balance. So this 2006 will be opening balance, 2007 will be closing balance. 2007 will be closing balance. So then, ladies and gentlemen, we move on like these. We move on like these. Then we have here, depreciation for the year was 4658. Assets with a carrying value of 1974 were disposed of at a profit of 720. Then they want us to prepare a statement of cash flows for the year ended 31st October 2007 for 𝐨𝐿𝐼𝐟𝐞𝐫. So this is an examiner who is wishing me success. This is an examiner for sure who is wishing me success. I'll be able to scale down this thing very fast. Very fast, I'll be able, ladies and gentlemen, in this case, I'll be able to answer this question pretty fast, very fast. Very fast. So then this is what I'm going to do right away. The examiner is silent regarding the method of cash flow statement that I should use. We have got 2 methods. We've got direct, and then we have what we call indirect. Whenever the examiner is silent, we shall always use the easier one. The easier one is which one? Is indirect method. Indirect method. And if it's indirect method, ladies and gentlemen, we have in this case here our cash flow statement. I know you guys know how to write the name. So this is our cash flow statement. Our cash flow statement of 𝐨𝐿𝐼𝐟𝐞𝐫 for the period ended whatever statement, like that, yes. So indirect method. Indirect method. So then, ladies and gentlemen, if it's indirect method, what do? We start with the profit before who? Before tax. We shall start with the profit before tax. Profit before tax. Profit before tax is here. Profit before tax is here. This is what I would want to pull down there. So my profit before tax is now here. And even the figure is given, the figure of profit before tax, I only need to come and put it here. Have my equals there. So, and then I'll be able to say page up. Page up. So page up, I'll be able to see my profit before tax figure here. And then I'll be able to say straight away enter. So that this 15,000 figure has already been picked up, Great. So then what I need to do here is to come. So then I should be able to come here and say adjusted for. So adjusted for. So this adjusted for, what do we have? Remember, it is dial. Dial, if you remember, you don't have to write this in a full. It is dial, God's number, G, like that. So of course, the first D here is depreciation. Depreciation. So we have here depreciation. We have in this case here impairment of goodwill. This question doesn't have any impairment. So we have here impairment of goodwill. Then we have amortization of intangible assets, amortization of intangible assets, and then we have loss on disposal, loss on disposal of assets, loss on disposal of assets, and then we have the last one, which is gain on disposal, gain on disposal of assets. Great. So now adjusted for depreciation, mine is a very simple thing. Adjusted for depreciation, like I can see the first one here is 720. Remember that our figures are in thousands. So depreciation, we are told, depreciation here, expense for there is 46.58. So this is what you shall come and put here. Depreciation, we have 46.58. Enter. From there, we have impairment. This has not been mentioned anywhere. Amortization, nowhere. Loss on disposal of assets, nowhere. Then we have gain on disposal of assets. You can see here, assets with a carrying value of 1974,000 were disposed of at a profit of 720 because the figures are in thousands. So then I need to come here and say, we have a disposal gain. A disposal gain, please listen and listen to me very well. A disposal gain must have been added here. So now I'm doing a cancellation transaction because it was added here. So then down here, I'll have to subtract it like that. So it has to be minus 720. It has to be minus 720. Great. The others, just leave them like that. We may be handling them later on. Now, ladies and gentlemen, please listen and listen to me very well. I would want you to appreciate this thing once and for all. So we have here, we start with profit before tax. Then we have adjusted for. So this adjusted for is something very important. It's like a title. So control, bolden, control B. And then here we have the concept of dial, God's number. We can see there was a gain on an asset that was done what year that was disposed, or an asset that was disposed. The others here would be 0, 0, 0 like that. So before I continue, let me give you guys some open window to ask a few questions as I proceed with this. Great. So this will come later. Thank you very much. They'll come later. Now, after that, ladies and gentlemen, thank you so much. After that, ladies and gentlemen, now listen and listen to me very well. Once now you've reached there, if you remember my video, when I say page up, if you remember my video, we said this profit before tax, when you have done dials God's number, you come back to this profit before tax, and then you look north. North means up. You look north, you look upwards, and identify any non-operational activities. Remember, when we talk about our operational activities, if it's RCM Online College, our operations, ladies and gentlemen, are as regards what year? Training. So then the training fees, revenue will be operational. If we have got any cost of sales, that will be operational, right? If I look north of my profit before tax of 15,000, north, I'll be able to see the investment income. So investment income, ladies and gentlemen, this is non-operational. I must deduct it. This is non-operational. I must deduct this. So then I'll come here, ladies and gentlemen, and then I'll be able to deduct what we call here. I'll be able to come here, go straight away here and talk over investment income. So this investment income is the same as dividends received. This is the same as dividend received. So this dividend received, I have a figure up there. What do you think in this case here should I do this figure of dividend received? Can someone talk to me? This dividend received, the figure is 180. 180. Of course, for us to have factored it in here, dividend investment, it must have been added. This figure must have been added. So now I'm doing a cancellation. So then I have to come here and do what here? Deduct. I'll have to less. You guys are bright. You guys are bright. So then what I'll do, ladies and gentlemen, I'll come down very first. I will come down very first. I will come down very first and talk of what here the figure is 180 but negative. 180 but negative. Then from there I go to the next one, which I see up there that is not, ladies and gentlemen, listen, that is not out of operations. It is these finance cost or interest. So I have my finance cost. I have my finance cost. I can come and pull it this way, say enter like that. And the figure happens to be, negative 400. You know, they subtracted, but because I'm canceling now, I need to go down page there and talk of positive 400. We talk of positive 400 like that. So first of all, up to there, are we together? The concept of looking north, looking up. You look up. Even if you don't understand these things, you can easily pass. You're looking up. You're looking up. Even if you don't understand this thing, you can easily pass. I hope they're following. Thank you very much. Now, ladies and gentlemen, from there, then, what I'll do, you must leave some space. Although for Excel, you don't even have to leave space. You can add, insert rows or columns later on. You don't have to leave any space. But just for purposes of showing that's a different thing, I can come and mention here, working capital changes. If you are not keen with your working capital, you will rest in peace. Working capital is all about liquidity. So liquidity, and I hope you guys appreciate why we normally call money currency, why we normally call money liquidity, cash flow. You know, ladies and gentlemen, we talk of currency like the Kenya shilling currency because really as a businessman, you must ensure that money is like current, not like how current, like the tides, like the ocean currents, right? Money should be flowing towards you, right? You need to know how you work with assets for you to ensure that you are always what here? Liquid. Don't be purchasing liabilities. We shall discuss about that, but for now you're supposed to know that whenever we talk about working capital, we are looking at liquidity. And if you mess with your liquidity, like I've seen so many young men messing up with their liquidity, they don't know what we call cash flow protection. Most of them were not taught very well. This is something which was not taught in high school, or even their mothers and fathers have never taught them. So they're not good in terms of managing cash flows. If you ask them whether they know what a money market fund is, they don't know. They have never been taught what bonds are. So in short, they are financially illiterate. These are those kind of guys, when they go to a club, they'll comfortably pay a bill of 30,000. They are very useless. But for now, what you're supposed to know, ladies and gentlemen, is that liquidity is the king in any business. You must protect your cash flows. Even as a family, you must protect your cash flows. Without cash flows, even for example, you would have not known more. You would not have paid fees. You do not have joined here. So cash flow is always king, right? If you don't have it, you'll always rest in peace. So come here, ladies and gentlemen, whenever we talk of working capital changes, so working capital changes, I'll come and put this bold, Control B, and then I'll come here and write working capital changes. So I know it's rest in peace, like this, RIP, like that. Although when you start studying this, of course, when you are doing it in Excel very fast, you'll come, you know, the first R is receivables. Just come and write there very first. Then we have, in this case here, inventory. Then we have the famous what here, payables like that. And then remember that for receivables, we talk of OC or O minus C. Even, no, it's O minus C like that. Then when I come down here, ladies and gentlemen, I should be able to say O minus C, O minus C. But now, when it comes to payables, because it's a liability, we normally invert this. So we talk over C minus O, core for a company like that. Remember, O is opening balance, C is closing balance. Great. So we'll come, ladies and gentlemen, here and look for these things now. So I'll talk over equals. So receivables. So receivables, if I say page up here, am I able to see receivables? Receivables, yes, opening. Remember, opening balance will be the earliest year given. So for receivables, the earliest year given is this. You say minus, all right? Minus, this is the closing, O minus C. O minus C. And then in this case here, what do? You say enter. When you go to, you see it's automatically, it's negative. When you go to inventory, again, inventory, it's O minus C. So you start by saying equals there, and then you say page up, you go straight away for inventory. Remember, it's opening minus closing. 2016 is opening, 2017 is closing. So for inventory, I'll come and pick this, and then I say minus this. No. That's not inventory really. That's not inventory. That's wrong. That's very wrong. So I'm supposed to pick for inventory. I'm supposed to pick 9630 something, and then I say minus this one here, and then I should be able to say enter. So you can see it is 6075. 6075. So I don't have, when I do it that way, I don't have to keep on wondering, is it an increase in inventory? No, that's not anything of my concern. When I go to payables, now it reverses. Now it's closing minus what here? Minus opening. So when I go to payables, so payables, I'll say equals there. I say page up. There is a page up. A page up. So for closing, payables, closing, I can see it's under liabilities. So closing, payables, it's here for 2017. This is the closing. And then I say minus the opening, which is this one like that. And then I will come and say what there. You'll come and say enter like that. Wish I'm an N. All right. Yeah. So then what you do, you come straight away here and they give us the gross operating cash flow. Call it gross operating. Call it gross operating cash flow. Don't mind whether you have you've left something. Don't mind whether you have left something. You'll be able to add in between. You just come and say here equals, and then you sum everything. You sum everything from here. Even if you have omitted something there, you'll be able to come and add later, and the summation formula you'll be able to take up like that. So after I get the gross cash flow, gross operating cash flow, what should I deduct to be able to get the net operational cash flows? What should I deduct to be able to get the operational cash flows? What should I deduct? Wrong figures for payables, right? Handled retained profit. I'm told that my figures are wrong. Depreciation is wrong. It's here. Finance cost is here, 400. Tax, I'll be putting tax here, less tax paid. I'm being told that my figures are wrong. Finance cost paid. Ndego is saying payable figures are wrong. No problem. Payable figures are wrong. No problem. Not a problem at all. Then I should be able to come and correct here. So I'll come and say equals. So I go to payables. So I'll be able to go to payables here, page up. Payables are down here. Payables here. So remember, for payables, I'm looking for closing. I say minus opening. Then I say enter. Yeah, you're right. So I'm getting here. for payables 3198, which gives me 26,568. 26,568. Thank you for that correction. Thank you for that correction. So any other stuff that you guys feel is wrong? Any other stuff that you guys feel is wrong? Or are we okay now? We move on. Are we okay? We move on. Are we okay? We move on. We're good. Thank you very much, Jacqueline. Thank you very much. Now, ladies and gentlemen, after that, so this is very important to me. I'll come here and say control bold. So then once I get my operational cash flows, what I need to do is to come and less tax. Out of the operational cash flows, always subtract taxation. So come here and mention there tax paid. So you less tax paid. You less tax paid. So tax paid, remember taxation, when I come and say here, ladies and gentlemen, equals, when I come and say page up, I go to taxation, and I go to taxation, I go to taxation. I can see taxation is here. Taxation is here. I can see taxation is here. Under liabilities. So remember that under liabilities, ladies and gentlemen, this being a liability, you must be very bright. Liability, whenever you're accounting for liability, what you need to do is to take closing minus opening. Closing minus opening. So remember, I'm repeating again, ladies and gentlemen, escape there. So I'm saying here, for a liability, very important, it will always be closing minus opening. But what if this liability item, we had some transaction that happened during the year? You see, let me explain something here. We have something very important, which I would want you guys to understand. And by the way, the moment you understand this, all of us should go and we start straight away kicking our blankets. I mean, we should go and sleep, because this is the most important thing. That we have like tax. You see, we have opening tax, we have closing tax. And then in between the year here, we have some tax obligation for the year, which went to the P&L. So we have opening, closing, flats, the tax for the year. How do we handle this? Listen, the moment we understand this very well, then we are done. Somebody already has mastered it here. You can see the answer here. Closing minus opening plus current. The only thing, yes. The only thing you guys haven't remembered very well, 𝐸𝐿, is the bracket. The bracket thing. Thank you so much. You guys are bright. You guys are very bright. Actually, I've got no business actually to do here. So I'm saying, like, for example, the taxation here, the tax liability, what was paid in the year, then I'll come and take closing minus into bracket opening plus tax for the year. Tax for the year. And then I close bracket. Tax for the year, or the one which is in the P&L. Great. So then what I'll do here, I'll come here and mention here equals. I say page up. Then I'll be able to take, remember it's an obligation here. It's an obligation. So it's closing minus opening. So go for the tax obligation. So the tax obligation, it's here. This is 2017, this is the closing. So you pick this 3020. You say minus. Please don't forget in this case here to say open bracket. Then you take here the opening. I'm saying open bracket because on the opening, I must add the tax figure, tax for the year. So the tax for the year, it is here. And you have to be very bright. You can see it is negative. It's negative. So you can, if it's negative like that, there's no problem. There is no problem. You can even come and type here. This plus 4350. 4350 is the tax for what year? For the year. Or you can come and say, if you want to cancel the negative, you can put a negative, but I don't want to go into those details. So you come and close your bracket like that, and then you say enter. So you can see the tax that was paid is 4090. So there are two schools of thought here, and I would want to sell to you this school of thought. But now in this case here, this will become the net operational, the net operational, the net operational, the net operational cash flow, the net operational cash flow. Then I should be able to come here and say equals, I want to sum the two. So I want to sum the two. So this and this, these two. So I put them there. I close my bracket like that. I know there is this other school of thought which tells us that, hey, you should also subtract the finance cost. But remember, the current International Accounting Standard number 7 tells us that nowadays, finance cost interest should always be accounted for under finance activities, So in this case, ladies and gentlemen, how I wish in Excel we had an emoji. Once I get this net operational cash flows, I need to come here and draw a very good emoji, which is smiling like that. Smiling like that. And then before I give you this data, you start working with it. Then what I'll do, I'll come here and talk about the second component. So the second component is cash flow from investing activities. So we have here cash flow from investing activities. So cash flow from investing activities. So investing, basically we look at our machinery, all right? Investing. We are looking at subsidiaries we have bought. So we're getting, in this case here, dividend income. It is. So whenever they talk of cash flows from investing activities, there are three things I'll always remember. These three things are which one here, ladies and gentlemen? We have in this case here, cash from PPE sold. Great. And then we have in this case here a cash paid for PPE purchased. And then the other investing, remember investing, we have bought, for example, shares in a particular company, like shares of Safaricom. Then we'll be able to talk of what here, investment income or dividends received. Dividends received, not paid, but received. So dividends received, this is the same as what here, investment income. Then once I have this, really, ladies and gentlemen, I should be able to be a happy person. So I'll start with the easiest, which basically is the investment income. When I say page up, so first of all, tab there, I say equals. So let me see whether I have this dividend income anywhere, page up. Dividend income, do I have it anywhere? Let me just check here, dividend income. Let me go up a little bit. Yes, I can see there is an investment income here. So what I need to do, nadunga tu, ili uzuri wa Excel nadunga. Unasema enter, ishaileta hapo, dividend received. Cash paid for PPE purchased. Cash paid for PPE purchased. This is quite a tricky one. Cash from PPE sold. Let us do this first. Let's do this first. So we say equals. So in this case here, cash from PPE that was sold. We can see from note number 2, assets with a carrying value of 1974,000 were disposed of at a profit of 720. This is very interesting. Financial accounting 1, when we started learning this CPA. So this carrying value is 1974, and there was a profit which was earned. So if I draw a disposals account, can somebody give me 3 entries of a disposals account? Can somebody give me 3 entries of a disposals account? A disposals account. Can somebody give me 3 entries of a disposals account? Is there anybody who is able to remind us the 3 entries of a disposal? I can see some good questions there, but first of all, let's finish this. Disposals account. Disposals account. Is there somebody who can remember 3 entries? They're normally 3. They're normally 3. The that when I dispose an asset, I'll go to the PPE account of the asset. PPE account. I'll go to PPE account and credit it. So I shall credit the PPE with the carrying amount. And then I debit disposal's account with the carrying amount. Then the other thing, ladies and gentlemen, when now I receive cash from this person, what do I do? When I receive cash from this person, what do? I will debit the bank and then I credit disposals. So I can see this disposal account. We are debiting it with carrying amount. We are crediting it with revenue received out of the asset. And then now we compare the two. When we compare the two, we shall either get a profit or a loss. When we get a profit is always credited to the income statement. You credit the income statement, you debit disposals. Let me simplify this thing for you. Whenever you are given carrying amount of an asset, and then you are given a profit was generated. Whenever you want to get the cash received, you shall take the carrying amount plus profit generated. Let me write this. Perhaps when I write this, it will be simpler for all of us. Let me write this. Ladies and gentlemen, please listen. We are saying in this case here that for us to be able to escape this, for us to be able to get here cash received from PPE, cash received from PPE. This is what you shall always do. You shall take carrying value, the carrying value which is the same as book value or net book value. You add profit. Gain. Or if it was a loss, no worry. If you want to know the cash you received from PPE, you will take, in this case here, whenever there is a loss, you will take the carrying value, but now this time round, you will take the carrying value, but now this time round, you subtract the loss generated. So in short, I would want you to listen to me. Please listen to me. We have sold some PPE. And fortunately, I can see the figures here. I can see there is a carrying amount of 19. So there is no debate about this. So I'll come here to be able to get cash received here. I'll come here and say equals. I can see I got 1974 there. And there was some profit generated. So plus the profit that was generated here of 720, it's a profit. We sold this at a profit. So plus 720, and then I hit what here? I hit enter. Very easy, 2694. It is cash received. From there now we go to PPE that was purchased. Now PPE, then I have to think about opening minus closing. Right? I must think about opening minus closing. All right? Opening minus closing. But before I continue, I would want, ladies and gentlemen, to... So when you have, ladies and gentlemen, this particular item called PPE, when you want to get PPE purchased especially, remember, I'm so sure most of you are so much used to these useless T accounts. They are very useless. Those are what we should be calling hot airs. Very useless. Yeah, revaluations, I love revaluations. Yes, they're very useless. Right? These are logical things. I should be able to think about them, and then I should be able. So like now, from what Haron Tirimba is telling me, when I see an asset has been revalued upwards, I know the value should increase. So the revaluation will be added to opening stock. Opening balance, I mean. When I see in this case here assets which were purchased, they should be increasing my opening balance. When I'm told there was some depreciation, they should reduce. So I subtract, and the closing, of course, will be subtracted. Let's work out this together with you. Great. So I would want to get this cash paid for PPE purchased. So in this case here, I'll come and say equals. I say page up, I go to PPE, which was I found under non-current assets. So I start with opening balance. I say minus closing balance, minus closing balance. Then from there, I'll go to my notes my notes in the accounts. So in my notes in the accounts, I can see, ladies and gentlemen, how the movements were. For example, in these non-current assets, we had some assets that were sold in the year. So I should be able to go and remember how much these assets here were worth the given year. Assets with a carrying value of 1974,000 were disposed of at a profit of 720. So here, remember, I'm not crediting with the sales proceeds. I'm going to credit the PPE account with the carrying value. So crediting means what? Here, subtraction. So I can't pick this figure in Excel. So I'll be forced to come here and say minus 1974, like that. All right. And then, ladies and gentlemen, the other thing that I'll be so keen with, I know it's assets that depreciate. So like this depreciation expense for the year was 4658. So I'll need to come and capture it here. So I need to come and say minus 4658. So if this was a serious examiner, he should have brought in issues to do with revaluations. If they told me that, for example, the assets were revalued in the year, say upwards by 200, I would have added. If they tell me that assets were valued downwards by 2, I would have subtracted. Although we shall come to this. So whenever it comes to these cash flows, try to disregard T accounts as much as possible. As much as possible. All right. And then, of course, ladies and gentlemen, now you should be able to come here and say what there, say enter. So you can see, ladies and gentlemen, that in terms of assets, really, we acquired new assets worth 23,340 here. And that is the end of this. So I should be able to get net investing cash flows. Net investing cash flows equals summation there. So like that. So I need to come and really just add the 3 items. I close like that. And then I'm mentioning them there. Net investing cash flows. So the last item before we call it a day, so control bold, very important for me. Net operational cash flows, these ones, I have to bolden them like that. So now we can go to the last one where we talk of what here, financing. Cash flow from financing activities. Cash flow from financing activities. Financing activities. So now, ladies and gentlemen, when you talk of financing activities, really, what should I think about? Very easy stuff. Very easy stuff. What should I think about? Very, very easy stuff. So the stuff that I should think about here, financing activities, if you wish, this is how you handle it. Financing, I've been financed. There are guys who have given me loans. So I will come and bring the interest component here. You can either bring interest here, interest paid, or here. Doesn't matter really. So interest paid. That is the first thing I'll always bring here. These guys financed my operations. They gave me a loan. So I need to pay them with some interest on top. Apart from this, of course, there is the concept of shares. So in this case here, we have a share capital, which could either be paid, received, talk of received, share capital received. That means that we issued more shares, In most cases, you issue more shares, like that. And then, of course, we have loans. We may have gotten loans or redemption of loans. You just mentioned their loans like that. Great. So if you allow me, I will begin. And of course, we have a very important here. We have the concept of what here, dividends. dividends, in this case here, paid. Because guys, when guys in this case here buy, where they give you share capital, you must pay them what here? Dividends. You must pay them dividends. Now, these dividends paid, ninasumbua wanafunzi sana, hii dividends paid. Wacha tuanze na hiyo dividends paid. Hii ndio usumbua wanafunzi. If I say tab, hii inasumbua wanafunzi sana. So for dividends paid, we normally use retained earnings account. Dividends paid. So say here page up, dividends paid, we use retained earnings. And if you're using retained earnings, ladies and gentlemen, then what do we do? Remember, retained earnings falls under liabilities. It's like a liability. It's like a liability, right? It falls under equity and liabilities. So then we should talk over closing minus opening. All right. So under retained earnings, closing is here for 2017. You say minus opening. It will be important to put this opening in brackets. So you put this in brackets here, opening. So you pick the opening here. But now remember, this opening retained earnings was increased by what here? Was increased by profit for the year. Was increased by profit for the year. I'll have to repeat this. I know this is a bit technical. So the profit for the year, if you look at the income statement given, if you look at the income statement given, we have profit for the year, 1060. So this is what you shall do. And then if you do like that, you'll be able to get what here? You'll be able to get, ladies and gentlemen, the dividend that were paid. Listen here, let me write this here. Let me write this down. To get dividends paid, as a financing item. This is normally what we do. We take closing, RE, retained earnings. We say minus open brackets, opening, retained earnings plus profit for the year. And then we close like that. This is something very important to get dividends paid. We take closing retained earnings. Don't forget the brackets, minus open brackets, opening retained earnings plus profit for the year. Then you'll be able to get these dividends paid. Now, please, let's go to the loans. Let's look at the loans. Loans will come right away here. Say equals, I'm looking for the loan obligation. Loan obligation page up. Do I have any loan obligation? Yes. So remember, loan, these are liabilities. So you're talking of closing minus what here? Minus opening. We're talking of closing minus opening. So we have closing, and then we say minus opening here. Of course, in the additional information, there is nothing they're telling us about loans. Nothing. They're telling us about loans. So of course, the difference would mean that you can see here, ladies and gentlemen, you can see here in terms of loans, in 2016, we had 10,300. In 2017, we had a reduction. So it means, ladies and gentlemen, we paid the loan. So if I say enter there, you can see we repaid 2,300. The moment I understand this concept of closing minus opening, then I'll not be worrying about the signs. Then let's go straight away to the share capital. So under share capital, what do I have? Again, nothing much really. I'll come and say equals there. I say page up. So share capital, where is the share capital? I can see it is here, ordinary share capital. So again, remember, it's closing minus opening. So closing, ladies and gentlemen, here, closing is this one for 2017 minus the opening figure, like that. There is no additional information like during the year we issued new shares worth, I would have incorporated them in this working, nothing. So simply come and tell us there, enter. Now from there, please give us the interest that was paid, in the year. The interest paid in the year, do we have an interest obligation? I'll come and say here equals, do we have any interest obligation? So page up. So I can see finance cost. But when I go to the liabilities, hatukuwa na opening wala closing liability interest. So then what that would mean is that we shall just come and pick this finance cost the way it is up there. So you enter like that. So in this case here, interest which was paid is like that. Great. Then, ladies and gentlemen, in this case here, you should be able to come and give us the net. So equals there, we say sum there. So like that, and then now you pick this really. You add them, you add them, you add them like that. You add them like that, and then you should be able to say what they are, enter like that. Now, so this means what here? These are net financing cash flows. Cash flows. I'll be able to repeat this with you again, so it should not bother you really much. So that is it. So control bold. So please come and give me the change in total cash flows. So equals, so you pick these bold ones. So we have operational, you say plus, we have this investing, you say plus, we have this net financing cash flows. So we have 181 there. Now this 181, you'll come and add what? You'll come here and add cash and the cash equivalents. Cash equivalents at the beginning of the year, at the beginning like that. So add cash and cash equivalents at the beginning. So tab like that, you say equals. So look for your cash, page up. Look for your cash. I can see cash at the beginning is 2016. But you see cash at the beginning is 2016, which is 1063 there. All right. I have to, you see there is a bank overdraft. Bank overdraft is a cash equivalent. So, and the bank overdraft has to be negative. So I'm taking the cash in 2016 minus the bank overdraft in 2016. So I'll be able to say here minus this bank overdraft in 2016, 429, sorry, 429 like that. And then I should be able to say there, enter. So I'm getting 634. So then what I need to do is to come and add these two. So I say summation there. So when I say summation there, I should be able to come and add those two like that. I say enter like that. So it means that this figure that we have here will be our cash, and the cash equivalent, and the cash equivalent, cash equivalent, cash equivalent at the end of the year, which in this case here is giving us what amount? 815. And you should be able to confirm whether this 815 is correct. So then how do you confirm? It's very easy, confirmation. So in this case here, look like that, talk of page up. So you come here, ladies and gentlemen, you can see cash at the end is 2045. You say minus the bank overdraft at the end, which is what here? 1230. So when you subtract like that, what are you able to get? 815, and this thing has reconciled. Great. I'm so sorry, of course, I had to move with quite a high speed for you guys to be able to pick whatever important things that are to be picked, so that now come tomorrow, I will be able to repeat this. I'll be able to repeat this like that.